In this video, I'm going to show you how we're using options data to make trading decisions in our expert advisors. This video is sponsored by our free Golden Time Bomb Expert Advisor. Take your trading to the next level through automating the London breakout and the opening range breakout. Click the link in the description to download the EA completely for free. So at Prosperity Algo Solutions, one of our big innovations is combining fundamental analysis in expert advisor form. And one of the ways which we do that is using options data and specifically put-call ratios to determine a bullish bias or a bearish bias for a given day. And to date, we've seen a lot of success doing this with the DAX for our German longbow expert advisor, where we look for bullish put-call ratios to go long, and coming soon, bearish put-call ratios to go short. And the idea there essentially is in options, there's two major categories of options. There's call options and there's put options. Calls give you the right but not the obligation to buy any sort of underlying asset at a given strike price. Whereas puts give you the right but not the obligation to sell any sort of asset or any sort of underlying asset of the option at a given strike price. And the idea is if there's significantly more volume of calls than there is puts, whoever is effectively initializing those trades and causing those calls and or puts to be bought, if there's more calls than there are puts, there is an implied bullish bias for the day. And that's why as the calls are the denominator, the smaller this number gets, the more bullish the options traders theoretically are relative to like the market environment. And effectively how it works is some people use the inverse put call ratio, some people use it in more of a basic signal context. But what I have found works well with these indices is use it more in the conventional form, where the lower the put call ratio is, the the more bullish the market is on a given day. And my theory behind that, and from the literature, my understanding is that as typically, specifically if you're looking at volume put call ratios, the speculators are those buying, not necessarily selling, whereas a good chunk of the people selling the options tend to be market makers. That makes it so that if there is significant volume in calls, that typically means that some sort of speculator and or people hedging a larger underlying position, for instance, are bullish, therefore implying that the market is more likely to be bullish on a given day. So that's a lot of technical stuff which I just went into, but effectively all we need to know for the purposes of this video is that the lower the put-call ratio number is, we should be expecting to see a bullish bias on the given day. And that's exactly what we've been seeing with the DAX. This is almost shockingly accurate how good it is. And because of that, we wanted to essentially get access to more forms of options data to be able to use this on different assets. And today I'm going to walk you guys through our American Longbow Expert Advisor, which is doing the exact same thing but using NASDAQ index options. So index options are a very popular form of security. The SPX index options are one of the most widely traded securities out there, and those are typically offered on the CBOE exchange. However, the NASDAQ index options typically trade on the NASDAQ. And here we're looking at the NDX option specifically. And there is no free available data, at least from what I can find, that goes back far enough on NDX index options. So what I did is I went to Polygon here, which is a market data provider, and I bought a data subscription, essentially to be able to query lots of historical options data. And why Polygon is so cool is it's very economical, and it also enables you to access many years of historical options data, where you can get everything from the exact volumes traded at the given strike prices, the expiration dates, and just extremely detailed analyses effectively showing you how options traded for a given asset on a given day. And what's really cool here is you can download flat files, which enables you to kind of get pre-packaged data. So you don't have to do 6 billion API calls to request every single possible contracts. However, for live trading, you can also use the direct REST API so that you're able to actually query the individual put call ratios for a given day in a faster, more efficient manner. So essentially what we did here is we went and downloaded around 4 years of historical options data for NDX index options, which are NASDAQ index options, and then we also developed some scripts to be able to query this immediately after time of closing. One of the big issues I find with using more of these free market statistics platforms given by the actual exchanges is they quite often have a lag. Eurex is pretty quick, but I was using the CBOEs, which is the Chicago Board of Options as well, for certain VIX and or S&P index options. And the issue with that is it takes them a long time to actually publish it. Whereas using these APIs, as soon as market closes, you can just query the live data and see all options which were traded on that given day. And that enables you to be way faster in actually responding. So not only is this more, you get a lot more data, you're also able to be way faster. And frankly, if you pay, it's to be expected, right? Whereas if you go for a free option, they are limited in what they're typically going to give you. And now let's hop over to the actual data which I downloaded. And we can see that this is all of the historical data that I took from the flat files and aggregated it into a nice tab. And we can see that we have the dates, all the calls traded, and this is like different strike prices, different expirations, all of the puts traded, the total volume. And then here what we're looking at specifically is the volume put call ratio. Sometimes you can see that there's something called a volume and or an open interest put call ratio. Volume refers to total puts traded over total calls traded on the preceding day. Whereas if you were to look at, or on the given day in this case, whereas if you were to look at open interest, that's the total amount of call positions open and the total amount of put positions open. For my intents and purposes, I find that the volume is more accurate because we're doing short-term trading. We're not trying to determine the general market bias, we're trying to determine what they're going to do in the next day. And because of that, if the market on a Tuesday was all of a sudden buying tons of calls, more likely Wednesday will be pretty bullish because somebody thinks that, okay, I should be buying a bunch of bets that it's going to go up, essentially ASAP. And that's essentially why we're using volume put call ratios here. And if we break it all the way down here, we can see that we can now go to the next tab and we can compare just the put call ratio and more specifically the previous day's put call ratio to whether or not that day was bullish or bearish. So once again, this is very important that you're not taking forward-looking data. So we're trying to avoid having any sort of look-ahead bias here. So what we're going to do is we're not going to look at the, obviously for the 30th of June, we're not going to look at the put call ratio of that day versus whether or not it went up or down, because we wouldn't have this ratio until this day is over, right? So that's totally useless to us. What we're going to look at is the previous day's put call ratio and then compare that to whether or not that day was a bullish day or a bearish day. And that pretty much enables us to see, is there any sort of statistical relationship between if the previous day's put call ratio was super bad and whether or not it was a red day. And by bad here, I mean super high. And if we go to our actual pivot table here, we can then analyze that. And we can simply see that if the put call ratios, for instance, were extreme at over 2, there was a 42% chance the next day went up. And then we're contrasting this with a baseline that 54% roughly of days in this sample size of the NASDAQ went up. Obviously, the NASDAQ is a bullish asset. That means that on average, it should go up more often than it goes down. So we're having around 54% green days. But we can see here that if the put call ratio is super bearish, we are going to have indeed a very lower probability that that day was green. And then kind of, obviously it's not perfect, right? We can see a distribution here, but the main thing is that on average, if we go below a certain amount, we can start to see that we generally start to introduce some degree of bullish bias if the put call ratios are low. And particularly if we start to filter out some extreme values here, we might actually have a way of kind of filtering out some losing days. So here specifically, we don't want to go too granularly either, because we don't want to cherry pick a certain threshold to introduce some sort of bias. We have to be really careful. But the main thing is just to do a very high level analysis to see, hey, is there any sort of relationship here? This relationship for the DAX was actually much stronger. The DAX is probably the best place where you can find this relationship, but there is clearly something going on here too. So what we can do now is we can take all of these put call ratios and actually put it in a little CSV file, which we can read from an expert advisor. And now here is our expert advisor, and this is the American longbow. And essentially all this thing is going to do is buy at the open, sell at the close, buy at the open, sell at the close, and it will do so using a put call ratio filter. So we can say hey, if we turn the put call ratio off, what will this look like? The previous one was with the put call ratio. So this is no put call ratio. As you can see, It still goes up because the NASDAQ is a bullish asset, and just like buying and holding effectively with leverage would work. But ultimately here, we can see that it's not nearly as good. Whereas if we go in and say like, hey, let's just pick a put call ratio of 1.4, and why I came to 1.4 is you start at 1 and then you increase until you maximize returns within a 10% drawdown or less. And you're doing this obviously in sample, out of sample. So I'm showing you the full period here, but your actual optimization will be done in a more kind of intelligent manner where you're being careful to not overfit or not introduce look-ahead bias. And then this would be the analysis with the put call ratio. So effectively, all we're showing here is that the put call ratio is indeed significantly improving our back test if we essentially use it to filter out days where we had very, very bearish put call ratios. And we can see here in the journal is that it's taking a day, it's looking for the previous day's put call ratio, and then it's deciding to buy. Whereas let's see up here, for instance, we had on, this would have been the 13th, we saw that yesterday's put call ratio was super high, so we are not going to trade that day. And then in addition to that, we're also adding sentiment analysis using Claude and Perplexity here so we can read the news and adapt in real time. And this is what will make this expert advisor significantly more enhanced than just buying and holding. Because you're buying and holding with some filters to really eliminate those bearish days. So guys, this was a walkthrough which was quite detailed, but essentially shows how we are using options data as a filter in Expert Advisor, as well as a trigger to essentially know what days are more likely to be bullish or not. Hope you enjoyed this video, and if you want to try this EA, sign up for a free trial of our prop firm bundle with a link in the description. Take care, have a great day.